I feel like tech investors have been waiting for things to turn a bit cheerier, and yet this October has been as scary as the Halloween month potentially promised. What exactly is going on here? Are investors just kind of tired of these FANG stocks?
It's been very ugly. I mean, there's a couple things going on. One thing you can say is you can couch it as this momentum trade, in a way unwinding, because of course a lot of these big tech names are all momentum names as well. And if you look at the momentum factor, it has really been taking a hit this quarter. So if you look at the New York FANG stocks and that index taking a hit, and the S&P 500 information technology sector as a whole. So some are saying that yes, they are more exposed to China in trade. At the same time, you keep hearing about these different regulatory issues. So we have some issues on the single company front, but also very much at large as you just see these names get pulled down as a whole.
And when you say folks are rotating out of this momentum trade, that makes me wonder, is this bull market coming to kind of its fruition if folks aren't so excited about these fast movers? How much underpinning this are people trying to kind of mitigate risk, or folks looking at this up into the right action and saying maybe it's time that it's finally over?
We are starting to see a lot of risk mitigation, but I wouldn't necessarily say that investors believe that this bull market is over. Some people were worried just because of the fact that tech has been so important to this bull market. But as we have seen this rotation out of some of these very large tech names, we've also seen a rotation into value. And even if you looked at some of the performance today, you see names like financials, like utilities, like consumer staples, some of these more classic value plays or defensive plays really getting a bid. So I think investors do feel a bit relieved that other sectors of the market can take this leadership position as tech in a way fails off.
And Brian, I want to dig into one of those names. Obviously, Facebook is set to report earnings on Tuesday. What in particular are you watching, and how much was that big sell-off last quarter kind of haunting investors as they're looking to those results?
Well, in terms of what I'd be looking for is just ongoing commentary about their what should be continuous expense increases and deceleration of revenue. And it's really just about the pace at which both are occurring, at least as management expects it. I am not convinced that the company fully comprehends the scale of investment they need to make in terms of making the product safe, for lack of a better word, for society, for advertisers, for everyone involved. And so I think that the risks are still to the downside there. And that's not even getting into spending on content that they'll need if they want to actually play in real TV advertising budgets, which they do. You know, in terms of the actual, the downturn, I mean, I think to your comments earlier, it has been more momentum driven more than anything. I think regulatory risk is a factor, but I don't really feel that investors fully comprehend how much is wrong with Facebook yet.
And that's a big statement there. I guess where specifically do you think the street should be looking in terms of what you do think is wrong?
Well, I mean, I think that everyone can form their own judgment if they lay out the problems for themselves. I've listed what I call a taxonomy of mismanagement, where I've described the company as structurally badly managed. And if you go through the dozen or so groupings as I come up with them, you'd really just start to question whether or not there aren't more risks. The other issue that investors aren't fully comprehending is the limit to growth for the total advertising market. That is not something that most investors understand. Anyone modeling Facebook on an ARPU basis does not understand the advertising market. Advertising is not based on an ARPU. You have to look at the total wallets, the share of wallet that they can capture from advertisers out there. And I think when investors start looking at the pool of available money from advertisers, they start to realize that they can't be modeling Facebook the way they've been modeling it. And I think then that starts to cause a reset of expectations over the long run.
So when you do look at where analysts are pegging Facebook for the upcoming quarter, last quarter they were surprised, and obviously folks didn't like that. It was more than about $120 billion in value got knocked off that stock in one day. In terms of analyst expectations, what are you looking at from an equities perspective for Facebook's earnings Tuesday?
So what's interesting is when you speak with analysts, a lot of people just say that they hope it doesn't get any worse. Of course, there's going to be a lot of focus on expenses, exactly how Brian was just talking, because we need to see what Facebook is doing, how much they're spending ahead of the midterm elections, what they're doing about these privacy concerns, but also about active users, of course, engagement, what's going on there. So analysts are expecting a bit of a pickup in active daily users from 2.23 billion to 2.28. So we'll see if Facebook can meet, because we know how ugly it got last time around.
So Brian, when you look at Facebook, obviously Instagram has kind of been pushed into the limelight here as the main core Facebook product has had some issues. How much pressure is on Instagram to perform, especially in the context of, you know, under your saying of taxonomy of mismanagement, Instagram's leaders are now out the door. What are investors looking for out of that part of the business?
Well, I think, first of all, investors are looking at the wrong things when they look at Instagram, because Instagram is an integral part of Facebook when it comes to the way they make money and the way that they're run.